Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, as always, Paul Peebles, National Underwriter for Old Capital Lending. Joining me today is Marshall Baker, taking the place of Mike Becker. Marshall is an expert on CMBS Lending for Old Capital. So say hello to Marshall Baker.
Hello, Paul.
Hey, Marshall. So before we begin our interview with Brad Sumrok, which I think everyone is really going to enjoy, I thought we'd talk a little bit about CMBS lending, what commercial mortgage-backed security lending is in this marketplace. A lot of people don't know what it is, but it's probably the number one or two ways of properties that are being financed these days is a non-recourse, long-term, permanent way of getting loans done. So Marshall, can I ask you maybe a couple of questions before we get into Brad? Tell me a little bit about why do investors like CMBS lending?
Well, many of our clients with a buy and hold philosophy find the CMBS loans compelling for several reasons, Paul. Above and beyond the competitive interest rates we see in the marketplace today, borrowers have the ability to lock in a 10-year fixed rate term and a 30-year amortization, which really helps the property's cash flow.
So what would rates be if we were trying to lock loans in today? Again, this is just not for multifamily, the CMBS stuff. It's also for office and warehouse and industrial and everything that you can think of that's a stabilized asset. So what would be interest rates would be in a CMBS loan?
Yeah, for interest rates today, they're indexed off of the U.S. Treasury rate, which today hovers around 2%. So the borrower's looking at a very attractive interest rate in the low 4s to 5s, depending on the structure of the loan.
So CMBS lending is not for high leverage. It's usually for medium leverage, which means it's anywhere from 60 to 65, maybe 70% leverage on a transaction. But it's awfully good for somebody that maybe does not have experience in ownership of a multifamily property or an office or retail property. So if you put together kind of a small syndication and that you need to have, kind of check the box that, or maybe you don't have the ability to check the box of ownership, the CMBS gives you a little bit more flexibility to do permanent financing that's non-recourse. And in areas that maybe that Fannie Mae doesn't lend in, like as an example, they don't want to do maximum loan dollars in Houston, but with the CMBS, we're able to do maximum loan dollars in an area that Fannie Mae's not going to do. So anything you want to add to that, Marshall?
One more item. Historically, the CMBS marketplace has required a minimum of $3 million for the amount financed, and we have a few niche sources that will go as low as $1 million for the amount financed. So it really opens up the opportunity to many of our clients.
That's great. Some great information. Thanks, Marshall.
I look forward to today's podcast. So without further ado, let's listen to Brad.
Fantastic. Thanks. Today in the Old Capital Podcast, we have Brad Sumrok. Brad is an apartment investor. He's a mentor and just an all-around great guy. I want everybody to meet Brad Sumrok.
Thanks, Paul. I'm glad to be here.
Thanks, Brad. Now, typically, Brad would be in front of about 350, 400 people on stage and talking a little bit about multifamily investing and mentoring. So we're honored to have Brad, just the three of us. We have Mike in the office, and we also have Brad here. So, Brad, tell us a little bit about your background before you became a multifamily mentor.
Thanks, Paul, for the introduction. My background, I learned from my parents early on that I needed to study hard and get good grades to be successful. So, I did that. I have an engineering degree, went to Carnegie Mellon in Pittsburgh, Pennsylvania. Any fellow engineers out there? Square peg, round hole syndrome. Never really knew what an engineer did until I became one. Mm-hmm. And spent the next 4 years trying to get out of engineering without taking a pay cut. So what did I do? I do what most people do. I went back to school, got another degree, an MBA. So I have 17 years of corporate America experience, worked for 5 different companies, was fired once, was laid off once, and didn't get into real estate until I was 35.
What made you want to get into real estate? What was the impetus for you starting doing that?
When I was 35 and after had just got a new job after being laid off, I thought, okay, this job may last 2 or 3 years, which the last few jobs that I had were 2 or 3 year stints. And then I found that I needed to move on And I realized at the age of 35 is, first of all, I wasn't making the kind of money I wanted to be making. And even more importantly, I didn't have the security or the freedom that I thought that having 2 degrees would give me. So I started looking for something else. And I had no idea it would be real estate. But I picked up a book that most people have heard about, and it's called Rich Dad, Poor Dad. And I read that book, and that book literally gave me the mindset that I was missing. You know, my parents taught me to study hard and get good grades and go to college. And Rich Dad, Poor Dad taught me, if you remember the cash flow quadrant, he taught me that I needed to be a business owner and or an investor, whereas I was focused on being an employee, and my goal was actually to move from an employee to the self-employed. So Rich Dad talked about 2 ways to become a business owner and investor, and one was network marketing, and the other was real estate.
And I see you haven't got into the soap business yet.
Well, the thing about network marketing is have you ever been sitting at a gas station filling up your tank, or sitting there at Starbucks and a stranger out of the blue just comes up to you and they say, "Hey man, that's a nice car. That's a nice pair of shoes." Right. You know, and then they pull out some juice and ask you if you want to take a swig of this juice, and that juice changed their life. And I just thought, you know what? I don't want to go up to strangers and try to sell them some magic potion or some magic juice and have to have a whole inventory of stuff in my basement. And so, you know, real estate was something that was tangible, and I knew there were people out there doing it. So that was something that I decided to get into.
So what year did you get into it? What was the first property you bought? When did you buy it? Tell us a little bit about your first deal.
Yeah, I got into real estate back in 2002. And, you know, the first step was I mean, think of it this way, guys. I spent 4 years to get an engineering degree and then another 2 years to get a master's degree, also that I can get a job, right? And so I thought to myself, well, maybe I should invest a little bit in my education. So the first step that I always tell people is if you want to be a real estate investor, and I don't care if it's single family or apartments, which is the only type of investing I do is apartments, but the first step really needs to be investing in your education. So that's what I did. I invested in my education, and 8 months later, I was able to buy a 32-unit apartment complex. And that was my first investment ever. So I completely skipped over a step that a lot of people do. A lot of people start off in single family, and they have this myth that is propagated out there somewhere that you need to start with single family and then maybe do a duplex or a fourplex and then an eightplex.
Sure.
And so, you know, I skipped over that. I invested in my education and bought a 32-unit apartment complex.
So tell us a little bit about that deal. So it's 32 units. Where was it located? Was it in good shape? It worked day one? Did it need a bunch of rehab? Why don't you just kind of tell us a little bit about that deal?
It was a perfect starter property. And here's why. I had a full-time job. Okay, and I didn't quit my job for 3 years until after getting an apartment. So don't everyone run out there and quit their job first, because having a job and some income will actually help you get qualified for the deal. Sure. You know, we go out and get conventional financing for these types of deals because it's the best financing available. So the deal was completely renovated by a guy that buys deals and renovates them, but he's not into property management. So there was virtually no rehab and no deferred maintenance for me to do. It was stabilized, which means that economically it was at 90% occupancy or above for at least the last 3 to 6 months. Okay. And there really wasn't a whole lot for me to do except buy it, find it, analyze it, and close it. And the property had a resident manager, and you know, I was able to find a handyman that would help me out. And so here I was, 8 months after investing in my education, I found myself owning a 32-unit property. I was still a full-time employee, and I traveled internationally 25% of the time. So to me, I bought the right property for me at that time. A lot of people go out looking for huge value-added deals, fixer-uppers on their first deal when they have no experience in a full-time job, and I would suggest not doing that. And one of the things I teach the people in my program now is to start on their first deal with a property that's stabilized and that has low deferred maintenance.
Good. And then, so after you bought that first 32-unit property, what was the next thing you did? When did you buy your next property? That
property was working out really well, and it was putting about $3,500 to $4,000 a month into my pocket. Then that's not each and every month, but on an average, on an annual basis, it made me about $40,000 a year. So that's about $3,500 a month or so. So I just thought, you know what, this is working so well. And I know the submarket. This was in Pasadena, Texas, by the way, a suburb of Houston, a working class suburb of Houston.
Okay.
And so the working class neighborhoods, to me, and what I call the C-class properties, are the sweet spot back then, and they still are today. That's where you get the best rate of return, the best cap rate, your double-digit cash-on-cash returns, and doubling your money in 5 years, which is my formula for what makes a good investment. So that deal was working out really well. It took up just a few hours a week of my time. The money was rolling in, and so I decided to do another one.
Okay.
So I got a bonus from my job, and I was in sales, and I had closed a deal. And instead of going out and blowing my bonus on a car or a toy, or something fancy,
Sure.
I decided to go out and buy another apartment complex. And so the next deal I did was 30 units, and it was about 2 blocks from property number 1.
Okay.
So now I had 62 units. They were 2 blocks apart, and I was able to obtain something that I call economies of scale. Now that I had 62 units in the same vicinity, I hired one manager that was a professional manager and one full-time maintenance guy that was HVAC certified. Instead of a handyman on the 32 unit, now I had a professional manager, professional maintenance person running 62 units.
Right.
And my life actually got easier, not harder. It took even less time, and I had better performance on those 62 units because I had professional staff.
Sure.
And that's when I learned the benefits of going bigger and having professional management.
Sure. And so what did you ultimately end up doing with those 2 properties after you owned them for a little while?
I love this part of the story because those 2 properties put about combined, say, $7,000 a month in my pocket.
Yeah.
And I still had my job. And my job paid me, say, $10,000 a month. Okay. And my goal was to get to $10,000 a month in business income or investment income. And by the way, I don't call it passive income unless you're a passive investor, because if you're the business owner, if you're the deal sponsor, you have, even though your work is outsourced to a property management company, there's still work involved. So I call it business income or investment income. So my apartment income was $7,000 a month. I wanted to get to 10. The next thing you know, I had brokers calling me up saying, "Hey, Brad, someone wants to buy the 30 unit you just bought." And my first answer was it wasn't for sale. And, you've heard the cliche, though, everything's always for sale at the right price. I mean, you've heard that before.
Sure.
And so that's what the broker said. He goes, "Well, you don't even know how much we're going to offer." And I'm thinking, but I can't sell, because if I sell, I'll never get to $10,000 a month. I mean, how am I going to quit my job? Because to me, I needed to replace my income to quit my job. And so I didn't want to sell, but then the offers started coming in, and I was like, oh my gosh, I can't believe the value of this property has gone up so much.
Right.
And that's really, if you look at NOI and cap rate, small changes in net operating income have huge changes in value,
Sure.
By a factor of over 10 in today's market. So I ended up selling property number 1. And then when I sold property number 1, I kind of lost the economy of scale that I had attained. So I sold property number 2 immediately afterwards. And next thing you know, I'm sitting on a capital gain cumulatively for 2 properties of over $1 million.
Wow.
And that all happened within 3 years. So like I tell people, I was able to invest in my education, buy 62 units that had double-digit cash-on-cash returns while I owned them, and then more than double my money in 3 years and make over $1 million. And that's when I resigned from my corporate America job, because I knew I could repeat it, I could systematize it, and I could do it on a larger scale.
Right. So what was next for you? You made $1 million, you quit your job, and then so what was the future from there for Brad?
Well, I didn't know what I was going to do. And I decided that, well, first of all, I had people that would call me up and say, "Hey, Brad, could you help me, analyze deals?"
Sure.
So I decided that I would start working to help other people with their deals. And my first venture into that was I was working with an organization that taught me how to get started in apartments. And, I worked with them for several years. I helped many people into their first, second, and third apartment deals. I only did one single family investment ever in my life.
Okay.
I did one single family rental home, and I've done over 1,400 apartment units.
All right, I want to hear about that. Was it owning a single family? Was that a successful thing to do?
Well, for many people, it's a good place to start. I'm not saying that you should never do single family, but what I'm saying is if you have the money or the ability to raise money from other people, and the ability to get the deal financed, which is what I teach. I mean, a lot of my students come to me with not a whole lot of money and no experience, and they're able to get into apartments from the get-go. But, for single family, after I had already had apartment complexes and I had professional management, I went out and bought one single family rental. Don't ask me why, I just decided to do it. And what I found is that single family rental took more time than almost running an entire portfolio of over 1,000 apartments that I had at the time. And how could that be? So here's just some examples. Well, number one, when I went to lease the house, I had to lease it. And that entailed me driving to the house and putting a for rent sign in the yard. And then I put my wife's phone number on the sign, but she said, you ain't putting my phone number on that for a lease sign. So I put my phone number on it. So now in my apartments, I got a management company that's doing all the leasing for me. The tenants don't have my phone number.
Sure.
In single family, people were driving by, Brad, how much is the house? I'm like, what do you mean how much is the house? It's $1,100. It's on the sign. Yeah, but I want to negotiate. Will you take $800? No, click, So, it took a lot of time. So I finally found the right tenant. And I did all the background searches myself. And again, in the apartments, they do all the screening for you if you have a professional management company. Then when the tenant moved out, I had to do the make ready. And I had to find a handyman. And he had to paint the house, and he had to fix it up and clean the carpet and all that kind of stuff. Then we moved in another tenant. Well, this tenant, didn't pay me the rent. And, that can happen sometime. Now, in apartments, if they don't pay the rent, on the 4th day of the month, you put, a 3-day notice to vacate on their door in the state of Texas.
Sure.
Okay. Well, this tenant, and that's probably what I should have done in single family, but, they said they were going to pay me, right? And because I didn't have a property manager, I bought into that story. And the truth is that I didn't want to evict them, and I didn't know how to evict them because even on my first 32-unit property, I always had a manager. Even though I didn't speak Spanish, she didn't speak English, she would just go to the judge and hold the lease up, and the tenant would be evicted if they didn't pay the rent. So even on my very first apartment complex, I never had to do any evictions. And I had this one single family house. The tenant didn't pay me the rent. And I'm thinking, now what do I do? So I'm online Googling, what precinct do I go to? What do I do next? What paperwork do I need? And finally, I said, I don't want to do this. So I called the owner of my property management company, and I begged her, bribed her, paid her, whatever. I mean, I paid her a couple $100 and said, could you please handle the eviction of this tenant?
Sure.
And so probably the best day of my life in real estate investing was when I sold my apartment to quit my job. And the second best day was when I sold my single family rental house.
That's funny.
I mean, I used to have nightmares about that single family rental. Honestly, I would wake up at 5 a.m. in a cold sweat.
That's funny. So you alluded to the fact that you had over 1,000 apartment units at one point. What was your peak? How many units have you?
I had over 1,400 units.
1,400 units.
And you know what? I did it over 12 years. So there's a lot of people that have more units than me, but I guess I have the slow and steady approach.
Sure.
And I'm still looking to buy. We just bought 190 units this past year, and I expanded my market. And now our latest acquisition was in Colorado Springs.
Okay.
Mike, Brad may tell you, he may not, but, he was the National Apartment Association Paragon winner of 2012.
2012.
Now, the National Apartment Association, I can't imagine how many members are even in that group. 100,000?
Well, there's got to be tens of thousands or hundreds of thousands of people. At their education conference alone, when I won the award in Boston, there were over 5,000 people at the conference.
So that's a huge award. He won it on a property called Pioneer.
Well, it was called Pioneer Creek Townhomes, but it wasn't called Pioneer when we bought it. It was called Arroyo Park, and it was the worst property in Arlington.
Tell us a little bit more about that deal, because I think that's interesting.
Yes, Arroyo Park, when we bought it in 2010, it was, if you remember the Continental Airlines book, From Worst to First, well, that's what we did with Arroyo Park. The property was so bad that the pizza delivery guy would not deliver pizza to the property because they were afraid of getting robbed.
Yeah.
And, people would call up and they'd say, no, we're not coming. Vendors wouldn't do work there because they didn't get paid by the previous owner. So we bought the deal out of foreclosure. That's what's called an REO property, real estate owned by the bank. The bank loaned us the money for the acquisition and the rehab, 70%. And, we bought it for $13,000 a door, which, by the way, you can't find similar deals today for $13,000 a door, but this was like a bad D class property with a lot of down units. It needed new roofs. It had foundation issues. It needed to be completely re-tenanted, renamed, and repositioned.
But in a great location, though.
Great location, major intersection of Arlington, Texas, lots of street traffic every day. So anyway, we did about a $1.4 million renovation on it. We renamed it to Pioneer Creek. We changed the tenant profile. We brought in new management. So that's what I call a complete reposition, re-tenant, rename. And right now that property is actually under contract to be sold. And the closing date is in December, and it's going to sell for $6.7 million. Wow. And we bought it for 2.8.
That truly is amazing how well you did financially on the transaction. But it's even better to understand how well you turned around the property and made it a much better area for the city, for all the tenants in the area. I think that's a well done. So you really are affecting people's lives.
Well, and to win that national award, they look at the financial performance, but that's not the major criteria. It's actually, what have you done to improve the community and the residents' lives? And, we have police reports from before and after showing all the activity before we bought the property down to virtually, now the police say this is a boring property for them to patrol. And that's what you want. You want the police department to say, yeah, there ain't nothing going on here. We could spend our time somewhere else. We've had residents that have sent letters to the manager in the property management saying how they used to be afraid to go outside of their unit at nighttime. And now they use the amenity centers that we've invested in the property, the pool area, the barbecue pits, the Wi-Fi center, in the office. I mean, completely changed the quality of the tenants' lives. So one of the things I love about the multifamily investing business is, obviously it's a great way to make money, but it's a feel-good business. And it's a feel-good business because if you do this the way, I don't want to say it this way, but if you do it the way I teach you to do it and the way my students are doing it, the way I do it, you're making a better life for the working class person.
Well, that's great. Well, it's probably a pretty good transition here. We have a lot of people who listen to the show that are new or aspiring apartment owners. Brad Sumrok's out there looking at a property. What's kind of your general philosophy? What do you look for? What kind of properties do you target when you're out there in acquisition mode?
Well, first of all, you got to buy in the right market. I've been blessed. I came to Texas as an engineer, and I've lived in Houston and Dallas. And over the past so many years, Houston and Dallas have been a great place to invest, as a lot of markets in Texas. But if you're listening and you're outside of Texas, Texas is not the only good market. So the first thing I ask is, what makes a good market before we even consider it a property? So one is you need to have a landlord-friendly environment. For example, does it take 6 months to evict somebody, or can you evict somebody in 30 days or less?
Sure.
Okay. And I know areas where people have said they were able to fight evictions for over a year.
Yeah.
Okay. So that's not a landlord-friendly environment. Two is you want to have population growth, past, current, and future projected population growth. And three, the same with economic growth. There should be past, current, and future projected economic growth. So when you take those things into account, it just so happens that a lot of the markets in Texas meet those requirements. I mean, Texas is a landlord-friendly state. We've had population growth and economic growth, and we continue to do so. But there are other markets that also meet that criteria. Some areas in Colorado, maybe Florida, the Southeast, Atlanta, Tennessee, North Carolina, just to name a few. So I have students that are, not only looking in Texas, but they are looking in markets that are ripe for an investment. Now, that's about the market. Now, the property, there are 4 property classes, A, B, C, and D. And to me, the sweet spot is the C-class property, which is generally speaking, but not all the time, the criteria for a C is working class demographics. Typically, it's a 1970s construction, but not all the time. It's more about the demographics and the rent per square foot that they're paying. Okay, so you buy a property in the Dallas area or in the Houston area that's somewhere in the 70s to 70 cents a square foot and built in 1970, and it's in a working class demographic, that's a C-class property. Yeah. And why do I like C-class properties? One is because you could buy them at a cap rate that will give you a double-digit cash-on-cash return if you buy it with realistic underwriting. And two, I look for a value add component. So not only am I looking for a cash flow while I own it, there's a lot of deals that will cash flow, but there's no value add component to it. Okay. So one of the things I teach is 3 rules to early retirement, early and permanent retirement, is the deal has to cash flow when you own it. And the deal has to have a capital gain component or an upside component. And if it doesn't, then I don't buy it. If all we look for is cash flow, then you might as well look at a mobile home park.
So when you're identifying upside, what are the things you look for when you're identifying the upside component? What are the telltale signs of the target properties?
The major source looking for upside is you're looking at net operating income and can you increase it?
And so what are the components? How do you specifically target properties, or what part of the income statement do you target to help increase the NOI?
So NOI is net income minus net expenses, right? And I look more on the income side, but I also look at optimizing some expenses. But on the income side, the main component of income of apartment should be rent. Okay. So are the rents below market? Okay. Or can we do some value-added improvements to improve the rents? And a lot of times you could come in and not doing only deferred maintenance, but by doing value-added improvements like improving the interiors, improving the curb appeal, improving the amenities. All those types of capital expenses may be able to give you an increase in either occupancy or rent or both. Okay. And so that's the main thing I look for. Now on the expense side, I'm not looking to go in and drastically cut expenses because now you're going to have a slumlord property. Sure. And you don't want to do that. But a lot of times we could optimize the expenses, say like by implementing water conservation or renegotiating electrical contract or just going through each line item and asking. Sometimes I've seen payroll where they have an extra person there that they don't really need to have allocated to that property.
Sure.
So by increasing income through rents and occupancy and optimizing expenses, that to me is the business model for any apartment complex in any city, USA.
Okay, that's great. So you mentioned that you're in the process of selling an apartment complex right now. What's your general take on the market? So is this you're in a state where you think everyone should sell everything? Are you buying, or what's your kind of we're in November 2014? What's your general take on the market now and kind of going forward for the next say 12 months or so?
I've been in this business since 2002. Now I know a lot of people that got in 2009 and they've only experienced one direction. Sure. And they've been in an up market. So I know some people that are like, yeah, I've been this for 3 years and I have the Midas touch. No, you don't have the Midas touch. You haven't made it through a down market.
Sure.
Okay. So there will be an up market. There will be a down market. And you got to understand what, I don't teach people to time the market, but I teach people to understand it.
Sure.
So right now, if you bought a property, say in 9, 10, 11, or 12, and you put in your allocated capital improvements and you increase the NOI, now is a great time to be selling. Okay. Now, some people would say, well, if now's a great time to be selling, then it probably isn't a good time to be buying. And my view is I am selling properties that I bought in 2010, 2011, and 2012 because we did our CapEx, we improved the NOI, we increased the value, and we could realize not only our cash flow, but our capital gain and deliver, say, a 20% plus internal rate of return to our investors. Okay. And that's a good return. Now, I'm also buying. How could you be selling, Brad, and it's a seller's market if it's such a seller's market and it's still a good time to buy? Well, it's still a good time to buy because the fundamentals are still strong. You can still buy a property today. Occupancies are all over the United States, by the way. The average occupancy is in the 96% range. In Dallas, it's, in the 95 to 96% range. And it's projected to stay fairly constant over the next 2 or 3 years. Rents have been going up. So you can still buy a property today, and with a realistic financial modeling or underwriting, there's still a value add component because the demographics have shifted. And that's what a lot of people don't get. There are less people out there today buying homes, and there are more people renting. Okay. There are less people getting married early, less people starting families earlier. So overall, we have more renters today than we did yesterday. We have less people buying and owning homes today than we did yesterday. And even with all the new construction, there's still more demand for apartments than there is supply. So I'm buying and selling. I know that was a long answer, but I'm selling the deals where we've completed our business cycle, and I'm looking to buy new deals that make sense.
And so when you're out there looking to acquire new properties, obviously you said you need cash flow, you need value add component. Are those deals still abundant out there right now, or are you having a harder time finding them? How tight is the market in your experience? And I know you have how many students are in your program?
Well, I mean, I have two programs, so I have, depending on the price point, I got a couple hundred students in both programs combined.
So you have about 200 plus students, give or take. So you have a lot of people out there that you're in connection with that are out there trying to actively buy deals. So how much more competitive is today's market than, say, 2010 when you bought Pioneer Crossing? Can you maybe kind of compare and contrast the up market that we're in today to the down market at that point in time?
Now, back in 2010, nobody was lending any money. Okay, and you didn't pick up the newspaper and see multifamily hot segment,
Sure.
So the people that knew the business, it was a great time for us. The only challenge was lenders weren't loaning any money. So how did we buy deals back in 2010 or 2009? Is we actually assembled groups of syndications, which are groups of individuals that are sophisticated or accredited investors, and we would put enough cash together to buy the property without a loan.
Okay.
And then in 2011, 2012, 2013, when financing came back, we would go out and put a first new loan on the property and pull equity back out of the deal. Okay. Now it's totally different. Now there's a lot of people, I was going to say lenders are throwing money at deals.
Lenders are throwing money at deals.
Okay. I didn't want to say that, but you guys are lenders, but I mean, lenders are throwing money at deals. Okay. And to get a 75 or 80% loan, not only to loan to price, but loan to price plus rehab is not uncommon. The challenge is that there are more people getting in that want to buy.
Sure.
People are willing to pay more money. And I believe that what I teach right now is even more valuable because I know there are some people coming in, and based on what some people were paying for these deals, and I run them through my spreadsheets, I don't know how they're going to make money. So there are still good deals out there. Students in my program are finding lots of deals, but you have to be careful. You got to make sure you understand how to underwrite deals correctly and not be too aggressive. So the underwriting needs to have some historical perspective. So yeah, there are good deals, but I probably look at 10 deals for every one we make an offer on.
Okay. And then, so you brought up financing, and since Paul and I are both multifamily lenders, when you're out there buying deals, what kind of lender execution or what kind of debt do you typically, prefer when you're out there looking to buy a deal? Do you prefer using bank financing or Fannie Mae, or what's Brad's philosophy there when you're out buying deals?
What I prefer now at this stage where I'm at, because I've been doing this for 12 years, is I like doing the non-recourse financing, which is going to come through government agencies. Mostly Fannie is the one I have most experience with, but there's also Freddie or CMBS that has a non-recourse program. And I like non-recourse now because it's to lower risk. But when I first started, my first two deals, I got bank loans. They were full recourse, which means you're personally guaranteeing the note. Every other loan that you make outside of real estate, if you have a car, it's recourse. If you have a student loan, it's recourse. If you have a home loan, it's recourse. So getting started, especially for value-added deals, a bank loan is a great product. And it also has a lot more flexibility sometimes than a Fannie Mae loan. In terms of prepayment penalties and the holding period. So to me, it really comes down to the specific property and your business model and your exit strategy, and you match the financing to that.
That's good.
Yeah.
So kind of recapping here a little bit, tell us a little bit about your program. You obviously have 200 plus students. Where can people contact you? Tell us a little bit about that.
And I'm going to jump in here a little bit. If you can hear the passion that Brad has, guy went to one of the best schools in the country. He started small. He's got a number of buildings that he's owned and managed and asset managed. And he's been the guy. If you don't use him to kind of help you, guide you through buying your first building, then you're going to be a little soft in the head, because I think Brad and his program does a very good job. And, he's not books and tapes and type of stuff like that. He did a 2-day class 2 weeks ago or so. He had 400 people show up for that. And his deal is completely different from the books and tapes. And when you hire Brad, you get Brad. And his cost is a small cost versus the mistakes you could make hiring the wrong vendor or going the wrong direction about purchasing the wrong property. You want somebody to hold your hand on a lot of these transactions, and he does a good job of educating you. So, Mike, I'm sorry to interrupt you there.
Well, thank you, Paul. So, my program starts with a weekend training event, and I call that weekend training event Rat Race to Retirement. How to earn double-digit returns and retire early by investing in apartments. And the reason I call it Rat Race to the Retirement is my personal story was I was 2 degrees in a corporate rat race for 17 years, and I retired in 3 short years after I got started investing in apartments. So during the R to R, which I call Rat Race to Retirement, R to R, so during the R to R weekend, I walk through the exact formula and process that I personally did to replace my corporate income with apartment income. And I walk through that step by step. It's a weekend training. I go through finding the deals, evaluating the deals, funding the deals, how to raise the money, how to find investors, how to underwrite, what to do at every step of the way. Okay. And after the weekend training, for those that want to continue having me in their life, I have 2 programs for that. I personally do all my own training, whether it's a bus tour, whether it's a webinar, and whether it's one-on-one coaching and mentoring. I personally do all my own training. So, there are a lot of national people out there teaching apartments or apartment mentoring or whatever. And some of these guys, they don't even show up. You go to a Rich Dad seminar. I'm not picking on Rich Dad, but that was just the one that came to mind.
Sure.
You see the free 2-hour Rich Dad seminar. Do you really think Robert Kiyosaki is going to be there? He's not going to be there. Yeah. There's going to be a guy in a suit that probably doesn't own an apartment complex, and he's going to say the first 10 people that run to the back of the room get a free book and a free bag. Okay? Yeah. So you come to my weekend training, you find out about it at my website. It's real simple, www.bradsumrok.com, just my first and last name. There's no C in my last name, so it's just bradsumrok.com.
Spell that for me.
BRADSUMROK at bradsumrok.com. Yeah. So that's where you can find out the information. My next one will be in March 2015. Okay. You get 16 hours of training about apartment investing. And then if you want to continue training with me, you have, option A and option B. And I have students from all over the country that come in. The one I did in November, we had about half of the room was from outside of Texas. So what I teach works anywhere. There are apartments anywhere. A lot of people want to invest in Texas, but a lot of people are investing in their own neck of the woods. I have a student looking at deals right now in Iowa and sure. Kansas City and El Paso and Albuquerque.
Brad, I certainly can't thank you enough for being part of the Old Capital podcast. We'll probably have you in here sometime next quarter or so just to bend your ear, maybe steal some good advice from you. So we appreciate it. Mike, anything more to add?
No, Brad, just appreciate your time. Thank you so much.
Thanks, Brad.
You're welcome. It's been fun.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.